Will be just about 30 more seconds and then we will be ready to go. Okay, awesome. Welcome to everyone attending on GoToWebinar. I'm also on Facebook Live right now, and I'm recording it on Loom. So there we go. We've got all three bases covered, and I'm going to activate my video so you can see me and share my screen. There we go. Welcome everyone to my Fab 10 end of financial year tax strategies. I ran this series last year and this was one of my most popular series. So I'm bearing in mind that some of you might have been listening to last year's one. Some of the strategies you can do are the same, but I've really tried to think about what is relevant to today. And I cannot believe that the end of financial year has come about already. How exciting. So a general disclaimer, I'm just going through basic tax principles. I'm trying to use language that you can understand. If you are after specific advice about your personal circumstances, I encourage you to speak with myself. I have a team with accountants, mortgage brokers, and financial planners, so we can assist in any area that you need in regards to your tax or finance situation. A small plug, there you go. What a lovely photo. See if you can see where I am. So last week, I was very privileged to be nominated as one of South Australia's 40 under 40 for passion, vision and achievements in South Australia, and made sure that I stood out there with my red dress. Just so happened to be at the front when they were taking the photo, but very strategically there, made sure I was wearing Fab Red. And I want to thank everyone listening in on this webinar, watching on Facebook Live, for being a part of the journey. My passion is to help people, and I want to thank everyone for your support in being part of the Fab journey of where we have been and where we are going, and being able to help as many people as possible and really empower you with your finances and to live your best life and to achieve your financial goals and dreams. So we'll see what we can do with the financial year tips for you. Okay. There we go, we've got another one playing in the background there. So tax time 2019, everyone's like, when do I get started? So just in case you're not sure, the ATO is going to start with accepting tax returns from the 5th of July 2019, and they say they're going to start paying them from 16th of July 2019. So if you want to get in there early, there are the dates for you to know, and they're aiming to finalise them within 12 business days of receipt. So I usually say about 3 to 4 weeks just in case, but I've been noticing sometimes they can come back really quickly, but this is what the ATO said. So stay tuned. There you go. For anyone getting tax refunds, always great to get in there early. For everybody else, then it's just a matter of booking in at a convenient time. I really want everyone, just be mindful. It is tax time coming up, and to be really vigilant about tax scams. I can guarantee the phone call. So what happens in our office, we have I need to speak to Miriam urgently. Like, you have to get her, I have to speak to her, and I know exactly what this phone call is going to be about. And the biggest scam that's been going around is a scam where it's a voice recording. So I've got it, and I personally did freak out when I got it. So it's a voice recording, and it's like, this is Benjamin Franklin from the ATO. You are getting arrested, and there will be is a warrant out for your arrest. You may go to jail. Call this number back. So people calling, I actually tried to call the number back and it got nowhere. But everyone's getting sucked into this. I've had clients crying about this and that type of thing. So just be vigilant. Like, if you're not sure, it's probably not the ATO. I do have clients that get calls from the debt collector. That is genuine, but we're more than happy to negotiate if you aren't sure if it is the debt collector or not. But a lot of these calls are just a fake scamming call, so ignore them. Ignore emails. I know clients have been getting, or just people have been getting emails where you've got to enter in your credit card details to get your tax refund. That is never going to happen. You do not need to enter in your credit card details, and text. So just be vigilant, be really mindful of your privacy and your identity. Don't give out your tax file number to anyone. And yeah, just be really vigilant of it, because it's going to be huge again this year. I anticipate a lot of the people were asking for iTunes vouchers last year to pay for tax debts with iTunes. So yeah, just be really aware and notice if there's anything suspicious with any of your friends, be aware. So hotspots in 2019, I was inspired to put some pretty pictures in the background because, you know, we're talking about accounting here. So areas to watch in 2019, the ATO have flagged rental properties. They've said they're going to double the amount of audits that they do for rental properties, and about 8 out of 10 people that lodge their tax returns with rental properties, the ATO think that they were done wrong and they were amended. So be really mindful to make sure you've got your numbers correct when you are lodging tax returns with rental properties. Just make sure if they understand the difference between repairs and maintenance. Of course, we as accountants will make sure you're calculating the correct interest. Make sure you're separating out the ownership correctly, because there's going to be certain things, like if you have significant losses with your rental property, it's probably going to trigger an audit. If you're claiming stamp duty in borrowing fees, it's probably going to trigger an audit. So one area in your tax return can trigger an audit on the whole of your tax return, and it's just something that the stress that you don't want to have to go through. So just make sure you're being consistent with your numbers. I believe probably the biggest area that this is going to trigger audits is potentially if you've got a holiday house and it's not getting rented out for the full year and it might have a significant amount of a loss, then you've got to be really mindful that you're being accurate with the days that you have lived in the holiday house in comparison to the days it was available for rent, and you're being truthful about that, just so that worst case scenario, there is an audit, there are no issues around, okay, well, we stayed in the holiday house for 2 weeks of the year, for the rest of the year it was genuinely available for rent, and that you've then claimed your percentages based on that. Cryptocurrency, another huge one, which was a big sort of bubble about a year and a bit ago. The ATO is tracking all cryptocurrency transactions from exchanges for like the last 5 years. So if you have invested in cryptocurrency, just another one to make sure that you're declaring it in your tax return. A lot of my clients have, and it's just a matter of working out, unfortunately, what their losses are with that, and then their losses can carry forward. Sharing economy is another hot one. So we're talking about Ubers, Airbnb again, Airtasker. So I believe the ATO is going to ask for everybody's details, income earned through all these sharing economies. The ATO has a huge amount of powers. They did that with Uber. They asked for every ABN for every Uber driver. So the same thing's going to happen with any of these sharing economy websites. The ATO can ask for details on every single person that received income. So better that you're putting it in now, exactly like they did with cryptocurrency. They're now asking all the Australian exchanges for details of every person that's invested. So just be mindful if you have earned any income from any of those areas to be declaring it in your tax return. The ATO also think that everyone is claiming too much in tax deductions, in their work deductions. So they think that clothing, laundry, home office, motor vehicles, and the $300 rule, people are abusing. So with the $300 rule, it's a total of $300. It's not, you can't claim $300 in every single area. And that's if you don't have receipts, and that's all. And the ATO is becoming like a bit of a stickler in, like, it needs to be for genuine work expenses. Motor vehicles, I know I've done plenty of discussions about this, but make sure if you are claiming for a motor vehicle that you're prepared to either show a logbook and show all your receipts, or claim the 5,000. If you're claiming up to the 5,000 kilometre method, that you have traveled those, that your employer is going to back you up on it, and or that you're carrying bulky goods. A lot of my clients have had problems passing an audit when they have left their employer's organisation. So they were working somewhere, they've now left, and then they have a hard time getting whoever from payroll to back them up on anything. That's actually been the most significant area that we've had problems when a client's been audited. The biggest one around that is actually self-education. So they've studied, they've spent $20,000 on a master's, and then they move to a different job. A $20,000 claim is going to flag an audit, and then they haven't been able to get in contact with their employer to be able to back up that their studying was relating to their job. And then the ATO has denied it, and it's been a whole big mess. So if you are claiming significant in some areas, just make sure your employer will be on board if you then leave. I'll see if we've got any questions. At the moment, no questions. Everyone's good. We're all going to be passing ATO audits. I would also say, this isn't in my notes, but definitely, and I can refer you on, if you do have a rental property and or you might have areas where are in the hotspots, you can get audit insurance, which means that it covers the accounting fees to deal with the audit. We have found that the process is not a pleasant process for anyone. It's quite stressful, and at least knowing that the accounting fees are taken care of if you unfortunately do have an audit. So the next area, and I always talk about this in my tax tips, but I've got to be careful now because the banking royal commissions happened and superannuation and everything like that is very highly regulated. I can't give any specific advice about this. I can just explain that they're the tax side, and I really want people to understand and educate people that superannuation is your money. So it is your future, and there are tax strategies that you can be doing depending on your level of income. So people on a higher income cannot do some of these tax strategies, but people on incomes under 250,000 can look at certain tax strategies which will reduce the amount of tax. So there is a negative in that. So what happened was a few years ago, and more people need to take this up. I'm starting to see a few people take it up, but the only way that you could get money into your superannuation was salary sacrificing. Then the rules changed a few years ago, and you can now make an after-tax contribution into your superannuation. So that is whether you're an employee or you're running a business, depending on your income level. So people on high incomes can't do this. And there are tax benefits. So when you contribute into your super, it's taxed at 15%. If you take it as a salary and you're on a higher income, it's taxed at 39 cents. So you are saving, if you're taxed at 39 cents, you are saving that 24 cents in a dollar on tax. The downside is that you can't access that money. It is for your future. So there definitely is a conversation that should be had with a financial advisor in this area to work out what your goals are, how much you need in retirement, and or probably the biggest issue that my clients face is they might have a mortgage at the same time as having superannuation. So a proactive financial advisor working in with an accountant, we have these in-house, should be able to help you work out what balance you could make, because this is a legitimate tax deduction and a strategy to reduce your tax. So I've had a question come through, and I'm probably going to answer this one at the end because there's going to probably be answers coming through for it. Single touch payroll. It's got nothing to do with surfing, but I was like, let's have a pretty picture in the background. This is the biggest change that is happening for businesses employing less than 20 people ever that I've seen in such a long time. So it's already in place for employers with more than 20 people, so 20 staff. Now, from 1 July, the government's going to make it that all businesses have to be enrolled in single touch payroll. There is an exemption. So if you are needing an exemption, let me know. But what does this mean? I've got a lot of employees linking up. So what does this actually mean for everybody? So what used to happen is businesses used to put in payment summaries at the end of the financial year. This is no longer happening. Businesses now have to live, so whenever they do their payroll, notify the ATO of the super, of the tax withheld, of the gross payment that they're making to you, which is their way of tracking to making sure businesses are being more accountable. Rather than having to wait a full year at the end for this information, they're now getting it live as they go along, which means a little bit more messing around with wages, because now we've just got to have a little bit more. But fortunately, most software takes care of itself. So I would be asking your employer, are you prepared for single touch payroll? And if they're not, find out why not, because they should be. But what it does mean for everybody is it is going to be the death of the payment summary or the group certificate. So we're no longer going to have that. And it is now going to be called the income statement. So if an employer reports through single touch payroll, which everyone's going to have to do from 1 July, they're not required to provide a payment summary to their employees. Income statements will replace payment summaries. Employees can access their income statements through ATO online services via MyGov at any time. So you should be able to get a running balance of what's going on through your MyGov. And employees will receive a notification when their income tax statement is ready so they can complete their tax return. So if they don't have MyGov, there's going to run into issues. This is the first time that's been introduced, and I have noticed some of my clients have been getting emails out. So if they've been working for an employer for more than 20 staff, they've received an email saying they're not going to get a payment summary. So I'm not 100% sure on how this is going to come through. I'm hoping it will be as usual. We'll still get a pre-fill report with the payment summary or income statement on it. So it's just going to have to be a wait and see. I believe a lot of businesses are not prepared for this. It means everyone has to basically be using a cloud-based payroll software. So if you are employed for a business that you don't think is equipped for this, let me know, because this is the most massive change that has happened in forever. Instant asset write-off. So this is more for businesses, but I think it's always good to understand what this is about, because even a lot of people thinking of starting a business always ask me this question. And the writing off an asset is great for businesses that are making profit. So if you don't have profit, you're not going to get you're not paying any tax, and there is no money back on this instant asset write-off. So it's great for, you have to be one making money to utilize this benefit. And this benefit has changed 3 times this year. So it was $20,000 up to 29th of January 2019. It then was $25,000, and it is now $30,000. So basically, the one that I see this getting used the most is for motor vehicles. So if you're an employee and you want to help your boss out and go, hey, do you want to save on tax? Maybe you can buy me a motor vehicle. Just make sure it's less than $30,000, and they can purchase this right before the 30th of June. But this is probably the biggest one that I see is getting people purchasing the motor vehicles for this. It is excluding GST, and it is staggered now throughout those ones. If you're an employee, just don't ever be fooled, and I talk about this, don't be fooled by the tax time ads. Unfortunately, none of this applies to employees. Anything over $300 gets deducted and depreciated. So this is small businesses only, and sole traders as well. So if you do have startup costs, which I'm kind of answering one of the questions here, if you do have startup costs, you will be immediately able to deduct it, but it sometimes doesn't make sense if there's no money coming in. You might just have a loss, which will then carry forward until your business makes profit. More than happy to discuss this. I get a question almost every single day about motor vehicles, and this is the one that it gets used on the most. I've had a question about, I'll come to the superannuation one later, but I've had a question specifically around a car costing $60,000. So above, there is a luxury car limit in there, but above a certain amount, there is no tax benefits for cars. So 60,000 is around that amount. I don't know exactly because it changes, but what will happen if your business or bought a car for 60,000, it gets depreciated over 8 years. So if you bought it on the last day of the month, you would get 1 day of depreciation. I often see a lot of clients buying laptops on the last day of the month. If you're an employee and you bought a laptop on the last day of the month because you saw the Officeworks ad, you'll get about $1 of depreciation. If you're a business, if it's under the 30,000, you can claim the whole amount. So the next one's a really interesting one, and slightly annoying that they've changed this rule because a lot of our clients claimed on this, particularly ones that invested in property and house and land packages. What the rule used to be is if you had an investment property and it was a house and land and you were waiting for it to get built, you could claim the interest because it was going to be an investment property. The ATO is saying people are abusing this, so they're buying land, they're not building for a while, and they're claiming just straight interest as a tax deduction. And this was announced in the budget last year, but it's going to be changing from 1 July 2019 so that you can no longer be claiming the interest in the lead up to when it is getting built as a rental property. As soon as it is built and available for rent, you can then claim from then onwards. Just the time beforehand, it will go to the cost base, so you'll be able to claim for it when you go to sell it. Slightly just, I don't know why they did this, but I think the ATO felt that too many people were potentially taking advantage of this loophole and delaying building and then claiming the interest for as long as they could without it potentially being a rental property. In all my clients' circumstances, it's always going to be a rental property. So one that I'm disappointed to be seeing going, and that's going to be from next tax year onwards. So we'll still be able to claim for it in this tax year if you have been building a rental property. Okay, just to be wary of tax